Hey everyone, welcome back to The Explainer. Today, we're unpacking a company that literally breaks absolutely every traditional rule of value investing out there. We're talking about NextDecade Corporation. Now, if you follow energy infrastructure, you probably already know the ticker. But, open their books and you're going to find this wild financial paradox, one that would honestly make Benjamin Graham spin in his grave. Yet somehow, modern Wall Street analysts are just pounding the table for it. So let's dig into exactly how that happens. So here's the core mystery. How on earth does a company with zero revenue command an $11.5 billion valuation? It's crazy. Wall Street generally loves this stock. Analysts are aggressively modeling upside, and institutional ownership is incredibly substantial. But man, the top-line numbers are guaranteed to make your jaw drop if you're used to traditional corporate valuations. I mean, in a classic Peter Lynch framework, you'd usually look for low institutional ownership to uncover a hidden gem, right? But here, the big money is already deeply, deeply entrenched, driving this massive valuation despite what we're about to see. Yep, you saw that right. $0. That is NextDecade's trailing revenue right now. Just a big zero. And that sits right alongside a staggering net income loss of over $354 million. Actually, if you were to run a strict Benjamin Graham defensive checklist, the one requiring consistent earnings, a solid dividend record, a moderate price-to-earnings ratio, this stock just fails spectacularly. There are literally no earnings to speak of. But then, you look at their enterprise value and it sits at a massive $11.56 billion. I mean, think about that. A multi-billion-dollar valuation for a company that currently has exactly zero sales. Just to put that into perspective, the market is pricing this pre-revenue entity like a mature mid-cap powerhouse that has been generating steady cash for decades. So the absolutely crucial point to figure out is how a zero-revenue company gets a free pass on billions in debt from top financial analysts. Well, to understand this paradox, we have to talk about discounted cash flow, or DCF models. The free pass basically comes from analysts looking entirely at the terminal value of what's being built. They're projecting decades into the future rather than evaluating present-day earnings. All right, moving on to our next section. Inside Rio Grande LNG and the cost of global energy infrastructure. To really understand the financials, we have to look at the physical reality down in South Texas. They are constructing a colossal natural gas liquefaction facility. We're talking massive production units known as trains, rolling out in distinct, incredibly capital-heavy phases. Trains 1 through 3 began construction in July 2023, while trains 4 and 5 kicked off in late 2025, with 6 through 8 currently in development. These aren't just buildings, they are decades-long structural commitments to the global energy grid. And this definition brilliantly illustrates what they are actually doing. When we say trains, we aren't talking about train cars on a track. They're immense, billion-dollar industrial facilities designed to supercool natural gas into a liquid state for global export. Now, if you're a Warren Buffett disciple, you're always looking for an economic moat, right? Well, the sheer scale and the literal billions required to build just one of these trains creates a massive barrier to entry. It's a physical moat that vigorously protects future cash flows. Now let's connect the physical to the financial. When you compare their $11.56 billion enterprise value directly to the hard assets, the property, plant, and equipment sitting on their balance sheet from Q1 2026, it comes in at $11.66 billion. Peter Lynch would explicitly call this an asset play. The valuation isn't based on earnings at all. It's anchored directly to that $11.66 billion in concrete, steel, and future pipeline capacity that's currently being constructed.
Which brings us to the balance sheet, decoding the balance sheet, and where the billions reside.
This is where we find one of the most complex corporate debt structures on the entire market. Just look at the sheer scale of the capital expenditures here. Over the trailing 12 months, NextDecade spent $5.25 billion. They are burning through over $5 billion in negative free cash flow just to build the physical foundation to eventually get in the game.
To fund this unprecedented build-out, they've accumulated $9.47 billion in total debt, which yields a net cash position of negative $9.33 billion. I mean, wow. For a standard company evaluated on a traditional Buffett or Lynch framework, carrying a negative $9.33 billion net cash position would mean instant bankruptcy, no question. But here is the absolute secret to their survival. They use variable interest entities, or VIEs. Subsidiaries like Phase 1 LLC hold this debt completely independently. It's non-recourse debt.
This artificially lowers the risk profile of the parent company, which, by the way, is a key assumption in those discounted cash flow models analysts are using. The debt essentially belongs to the specific project, not the parent, shielding NextDecade if a specific phase happens to hit a wall. Let's look at their strategic pivots and leadership, trimming the fat and focusing purely on flow. To survive this incredibly vulnerable development phase, NextDecade is making some massive strategic pivots. They recently made headlines by scrapping their highly publicized carbon capture project, completely withdrawing it from FERC review. Instead, they pivoted all their energy to partnering with giant players like TotalEnergies to lock in offtake contracts to unlock Train 3. Honestly, this is the most crucial part of the investment analysis. These offtake contracts are rock-solid guarantees that a buyer will purchase the gas for decades. These specific contracts are the exact numbers that analysts plug into their DCF models to generate that $11.5 billion valuation. Without them, the company is practically worthless. Take a look at this quote from CEO Matt Schatzman. "We look forward to partnering with John as we transform NextDecade from an LNG development company into an LNG operating company. That perfectly captures their current inflection point. They're pivoting from being a construction company just burning cash to a utility-like operator that will reliably generate cash." And to manage that critical transition, they brought in John Zuklic as their new CFO, taking over in July 2026. He is a 30-year operational heavyweight from Sitego and Phillips 66. Doing a classic Buffett management quality check here. Bringing in a veteran with a specific resume signals directly to Wall Street that management is deadly serious about making the transition from building steel to actively managing positive global cash flows. So, what is Wall Street's verdict, and why do analysts look past all that debt? With zero revenue, a multi-billion-dollar cash burn, and nearly $10 billion in debt, what does the broader market actually think? Well, despite failing almost every defensive value investing metric ever written, the consensus is incredibly optimistic. When we look at analyst ratings, it's an even split: 50% strong buys, 50% holds, and absolutely zero sell ratings among top analysts covering the stock. Zero. Analysts are modeling an average price target around the mid-$9 range, specifically $9.45 against a current price of $8.40. They're predicting double-digit upside. Analysts are just aggressively looking past the negative return on equity today. They're running those discounted cash flow models projecting out to 2030 and beyond, and discounting those massive future offtake revenues back to today, which gives us that $9.45 price target. Finally, let's talk about the road to revenue. When does the gas actually flow? The payoff here requires extreme patience, folks. Based on their guaranteed contracts, the expected commercial operation of Train 1 won't even hit until late 2027. Then Trains 2 through 4 stagger into production from 2028 through 2030, with Train 5 commencing in 2031. You really have to remember that a DCF model is highly sensitive to time, specifically the discount rate. If Train 1 gets delayed past 2027, the present value of the stock drops significantly. That timeline is absolutely the main risk the market is watching right now. Which leaves us with the ultimate question. For a Graham or Buffett disciple, the total lack of current earnings makes this completely uninvestable. But if you believe in a discounted cash flow models, the massive physical asset base, and the timeline of those offtake contracts, it might be a calculated risk. When those billions in non-recourse project debt finally come due, will the gas flow fast enough to cover the tab? It's a high-stakes race in South Texas for sure. Thanks so much for joining me on this explainer, and I'll catch you on the next one.